Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at American Fund's growth model portfolio. The strategy is quite simple. It is to provide exposure to growth stocks in the US and internationally. So let's see how this portfolio has done. And we're going to kick off with a short holdings analysis. So this portfolio is comprised of 7 American funds, and well, the weights are somewhere between 10 and 25%. The largest allocation is to the Growth Fund of America, which I think is a gigantic fund with hundreds of billions of assets. And the total portfolio fee is 49 basis points, which makes it quite expensive. Most of those funds have track records that go back decades. And so we can see the performance of the current holdings going back to, well, before the financial crisis. We also see a nice outperformance versus the benchmark selected by American funds, which is a combination of S&P 500, 75%, and ARCI ex-US with 25%. And given the split between US and international stock, that seems to be an appropriate benchmark. Now, on a first look, that seems to indicate that American funds has done great because we can see that the model portfolio outperformed. Having said, that's of course only the performance of the current holdings, and often, well, there's a bit of performance chasing going on. If we do look at the fact sheet, we do see that the strategy has inception date in 2012. So we have more than 10 years of data, or track record to be precise. And we can see the gross return was 13.15%, the net return 9.83%, but the return of the benchmark was 13.29%, i.e. higher than the net and also the gross return. Stated differently, American funds hasn't created any value with this strategy. We can investigate a little bit in terms of how similar or how different this portfolio is comprised of its benchmark. It's of course an all equities portfolio. We have a split between the US and international between 75, 73, and kind of 18, 17%. So there they are very similar. We do see that American funds portfolio has a slightly smaller allocation to large caps, but a larger allocation to small caps. We can also see, if we look at a sectoral breakdown, that there is an overweight in tech stocks and an underweight in financials. And that makes sense because technology companies tend to grow faster than financial companies. If we change the perspective from sectors to factors, we can look at popular equity factors. And what we do see is a consistently negative beta to the value factor and low volatility factor. Again, that's just the mirror image of that overweight in technology companies because they tend to be expensive and quite volatile. The exposure to other factors like momentum, quality, and size was time varying. Having said that, we also can look at this from a risk perspective, and overall, the equity factors have contributed almost nothing over the last 15 years or so. It's basically all equity risk. The next question that we can ask ourselves is if this portfolio is constructed thoughtfully. And unfortunately, what we often see is that asset managers combine funds that have offsetting factor exposures. So you might have a fund that has a positive beta to the value effect, another one has a negative one. And that, of course, just nets these off. Having said that, in this case, the portfolio is relatively thoughtfully constructed. You can see, for example, there's a consistent negative beta to the value factor as expected for growth stocks. With regards to the size factor, well, you got a small cap fund in here, which in this case, you have an effect the netting occurring with regards to the other funds that are more large cap focused. But broadly speaking, right, there's not too much factor netting going on. If you like this portfolio, but you think it's too expensive with 49 basis points, here we, for example, show you that you can replace certain funds with just cheaper versions. So, for example, you could take, the fundamental investors fund, which is charging 38 basis points. And you could replace that with an S&P index tracker that is simply charging 14 basis points. You're saving 24 pips. On portfolio level, effectively you get something that is fairly close from a return perspective, but only costs 15 basis points versus 49. If this portfolio is too complex for you with 7 holdings, you can also simplify it. So there's of course some overlap in this portfolio. And as mentioned at the moment, this has 7 securities. You can reduce it from 7 securities to 3, which then simply comprised of, well, the Russell 3000 total world stock market index and the S&P 500 growth index. And that gives you pretty much the same return, but, well, again, you can reduce fees from 49 basis points to 12 basis points. So this concludes our short review of American Fund's growth model portfolio. Unfortunately, we do see, what do we see in many model portfolios, that the performance of the current portfolio looks great. The actual track record doesn't. In this case, the portfolio has underperformed its own benchmark since 2012. And given that this portfolio, well, exclusively uses expensive American funds portfolio, it's also quite expensive, and you can easily reduce fees from 49 basis points to 12, like in this case. Hope that helps. Have a nice day.